Nurturing financial stability. A guide to bonds, CDs, and treasuries for every investor stage. Bonds, certificates of deposit, CDs, and treasury securities, treasuries, are pivotal instruments for investors seeking stability, income, and diversification in their portfolios. Whether you are a novice stepping into the financial world, a seasoned individual refining your strategy, aiming for early retirement, or on the brink of retirement, comprehending the fundamentals of these assets and their diverse investment options is essential. In this article, we explore the basics of bonds, CDs, and treasuries, delve into their various types, and discuss tailored investment strategies for investors at different stages of their financial journey. 1. Basics of bonds, CDs, and treasuries. Bonds. Bonds are debt securities issued by entities, corporations, governments, to raise capital. Investors lend money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. Certificates of deposit, CDs. CDs are time deposit accounts offered by banks or credit unions. Investors deposit funds for a fixed period and earn interest, typically higher than regular savings accounts. Treasuries. Treasury securities are debt instruments issued by the U.S. Department of the Treasury to fund government expenditures. They are considered low risk and include Treasury bills, notes, and bonds with varying maturities. 2. Different types of bonds, CDs, and treasuries. A. Bonds. Corporate bonds. Issued by corporations to raise capital. They can range from investment grade, lower risk, to high yield or junk bonds, higher risk. Municipal bonds. Issued by state or local governments to finance public projects. They often offer tax advantages. Government bonds. Issued by national governments and considered relatively safe. They include U.S. Treasury bonds, notes, and bills. B. CDs. Traditional CDs. Fixed-term deposits offering a fixed interest rate. They have penalties for early withdrawal. Bump-up CDs. Allows the investor to request a higher interest rate if rates increase during the CD's term. Brokered CDs. Purchased through brokerage firms, offering more flexibility but potentially higher minimum investments. C. Treasuries. Treasury bills, T-bills. Short-term securities with maturities ranging from a few days to 1 year. Treasury notes. Medium-term securities with maturities ranging from 2 to 10 years, offering periodic interest payments. Treasury bonds. Long-term securities with maturities of 20 to 30 years, providing semi-annual interest payments. 3. Investment strategies for different investor profiles. A. New investors. Strategy. Start with Treasury bonds and traditional CDs. New investors can begin with low-risk options like Treasury bonds and traditional CDs. They offer stability and relatively predictable returns. B. Experienced investors. Strategy. Diversify with corporate bonds and brokered CDs. Experienced investors can diversify their portfolios by adding corporate bonds for higher yields and brokered CDs for flexibility. C. Investors aiming for early retirement. Strategy. Prioritize municipal bonds and bump-up CDs. Investors aiming for early retirement may benefit from tax advantages with municipal bonds and the potential for higher rates with bump-up CDs. D. Investors nearing retirement. Strategy. Emphasize Treasury bonds and traditional CDs. Investors nearing retirement should prioritize safety and income. Treasury bonds and traditional CDs can provide stable returns and capital preservation. 4. Risks and considerations. Interest rate risk. Bond prices fluctuate with changes in interest rates. Credit risk. Corporate bonds carry the risk of issuer default. Liquidity. CDs and some bonds may have penalties or restrictions for early withdrawal. Inflation risk. Fixed-rate investments may lose purchasing power over time due to inflation. Conclusion. In conclusion, bonds, CDs, and treasuries offer varying levels of risk and return, catering to different investor needs. Whether you are a novice investor, an experienced individual, aiming for early retirement, or nearing retirement, there are strategies aligned with your financial goals. By understanding the intricacies of these assets and aligning your investments accordingly, you can potentially build a diversified and stable portfolio that supports your financial objectives at every stage of your journey.